Welcome to the Deep Dive, where we take dense, often overlooked source material and really distill it down into essential knowledge.
Glad to be here.
Today, we are looking at something that sounds simple but is anything but. We're getting into the quiet battlefield of localization,
Right.
specifically for Turkish language financial software. Now, for most of us, localization just means swapping words. Assets becomes varlıklar.
A simple find and replace, in theory.
Exactly. But when you get compliance and regulatory bodies involved, especially in a place as fiscally fragmented as the Eastern Mediterranean, that simple word swap becomes a really high-stakes legal engineering challenge.
It really does. It stops being about grammar and starts being entirely about fiscal law. It's a fascinating example of how a technical detail can decide if a business operates legally or, well, not.
And that's what our sources today get into.
Yeah.
Our mission is to understand how a single Turkish interface has to support two profoundly different fiscal systems
At the same time.
at the same time. One for the Turkish Republic of Northern Cyprus and the other for EU and Hellenic standards in Greece. Then we need to look at the rigorous, almost obsessive standardization of technical terms needed to make it all work safely.
It's quite a puzzle.
Okay, let's unpack this.
So the foundational problem here is really about, let's call it fiscal geography.
Fiscal geography, I like that.
When you localize accounting software, you're not localizing a language, you're localizing a regulatory obligation.
Right.
And if you're building software for Turkish-speaking businesses, you immediately hit this geopolitical and financial split. Are you serving a company under TRNC law or one in, say, Greece that uses Turkish but has to follow EU directives?
I have to push back on that a bit. How do developers even manage that? It sounds like inherent system schizophrenia. Did that just make the software prohibitively expensive?
That is the critical challenge. It means building a core engine that can basically operate in two different regulatory modes.
So for the TRNC,
For TRNC compliance, the system is rooted in their laws, which are very closely based on the Republic of Turkey's system. And this mandates the use of the Turkish Uniform Chart of Accounts, the TDHP.
okay, so that's one mode. And if you're localizing for a Turkish user in Greece, how does the system flip that switch?
The whole underlying structure has to flip. That localization has to conform to EU directives, specifically the Hellenic Accounting Standards, known as EA, and those standards are intrinsically linked to the International Financial Reporting Standards, IFRS, for SMEs across the EU. So even though the user is reading Turkish words, the database structure has to satisfy that 10-class EU framework.
So it's the whole philosophy of the chart, the classification method that changes, not just the labels.
Precisely. The TDHP is traditionally built around 9 main classes 1 through 9. And while both systems track the same broad concepts, assets, liabilities, equity.
Usual suspects.
Right. The EU compliance system needs a 10-class structure, which is often designed for easier IFRS harmonization. So for the Turkish version serving the EU market, you have to map and translate that 10-class structure using TDHP terms where they align, like Duran Varlıklar for non-current assets, but you have to keep the EU structure underneath.
That difference, 9 classes versus 10, might sound academic, but it completely dictates how you generate and submit financial reports.
It absolutely does. And the mandatory ID requirements really reinforce this split. If you're a Greek entity, your identifier is the AFM, your tax ID.
Okay.
But if you're a TRNC entity, you use the local VUK equivalent. The software has to be smart enough to demand the correct, locally mandatory ID during setup and for every single transaction after that.
Let's focus on that foundation for the TRNC system, the TDHP. If I'm a Turkish accountant trying to comply with TRNC rules, what does that chart of account structure really mean for me? Why does it matter so much?
Well, the TDHP isn't optional. It's the legal backbone for statutory reporting there. Instead of just rattling off numbers, you should think of these classes as functional departments. They define where every single transaction has to land for compliance.
Okay, so give us the importance of a few key groups.
Let's take Class 1, current assets. This is everything that's fluid, constantly moving. Your cash, which is kasa, your immediate debts owed to you, aluçlar. It's your liquidity snapshot.
And what about Class 7?
Then you jump to Class 7, which is like the engine room of expense, tracking the cost accounts.
And why is Class 7 so critical for regulators?
Because it forces you to separate costs by function. For instance, account 770 is for general unitum guidolari, or general administrative expenses. A regulator needs to know if a big expense relates to selling goods, making them, or just running the office. Class 7 provides that mandatory separation. It ensures transparency.
You also mentioned Class 9, which sounds a little unusual, a bit outside the typical balance sheet.
Class 9, the Nazim Hesaplar, or off-balance sheet accounts, are fascinating. They're purely statistical memo accounts. They track commitments like guarantees you've issued or mortgages that haven't hit the main balance sheet yet but are crucial for regulatory disclosures.
So without Class 9, the picture's incomplete.
From a fiduciary standpoint, yes, completely incomplete.
That structure must force an immense amount of detail, right?
Yeah.
It's not just broad categories. It's tracking every single vendor within those categories.
Absolutely. The TDHP system requires depth. The sources are clear on this. Main accounts, like 1020 for a bank, use 4 digits. But to track individual customers, which you need for the mandatory forms, you go into subsidiary accounts, Moavan Hesaplar.
And those are longer.
They have to be 5 digits or more, like 1201.001. That extra depth lets the software track thousands of individual counterparties, but still roll everything up into that 4-digit statutory requirement. What's fascinating here is that while the TDHP and the EU standards are different on a macro level, the real regulatory landmines are in the micro details.
Ah, like tax rates.
Exactly. Tax rates and local payroll funds.
That's where the rubber meets the road. The tax differences that can get a business shut down. Let's talk about VAT or KDV. How does that splinter the accounting structure?
Well, the basic mechanism is universal in Turkish-speaking regions. You use account 191 for indiralçek KDV, that's input VAT, what you pay, and 391 for hesaplan and KDV, output VAT, what you collect.
Okay, that sounds standard.
It is, but the problem is the rate structure.
Give us the divergence.
Mainland Turkey operates with primary rates like 1%, 10%, and 20%. The TRNC, though, under its own laws, uses a 5% reduced rate and a 16% standard rate.
So wait, if a company is selling the exact same product, same description, the software has to know if it's the Turkish 10% or the TRNC 5%.
Precisely. And it's not just a display problem, it's a reporting problem. If you just use a single 191 account for all your input VAT, you can't separate your 5% purchases from your 16% purchases.
Which you need for the tax return.
To generate the local KDV return, the KKTC, KDV BNMAZ, you must have those figures segmented. This is why the sources insist on mandatory subaccounts.
So the difference between operating legally and making a critical tax error is literally a 2-digit suffix.
It is. A TRNC business must use subaccounts like 191.05 for 5% purchases and 191.16 for 16% purchases. If you accidentally book a 5% purchase to a subaccount set up for 20%, your KDV report is fundamentally flawed.
An instant audit risk.
Instantly, the software absolutely has to enforce that granular distinction.
If VAT is that complex, I can only imagine payroll is a regulatory minefield, since social systems are almost always hyperlocal.
Payroll is where the customization gets really intense, especially in the TRNC. Unlike a lot of centralized systems, TRNC law requires dedicated tracking for 2 key social funds, Social Sigorta, which is social insurance, and the Itiat Sandia, the Provident Fund.
So how does that look on the books?
In the ledger. It forces a very specific liability separation. When an employer withholds money for that provident fund, the deduction creates a specific liability, say under account 360 for taxes and funds payable. It would have to be something like 360.x.02 for Ujin Nachet Kiat Sandia Kazantilari.
You can't just lump it in with general taxes.
You can't, and the expense side is just as demanding.
How so?
You can't just throw the employee's gross wage and the employer's contributions together. If you're using account 770 for general admin expenses, the gross wages brute ukritler dash might be 770.01, but the mandatory employee contribution for social insurance, the Ijverin Social Sigorta Paylari, has to be posted separately, maybe to 770.02.
And that separation is for the regulator.
It's so the regulator knows exactly what is direct wage cost versus what is a mandatory social contribution.
Here's where it gets really interesting. We've talked all this time about the fiscal engineering, but the actual language in the interface has to be aggressively policed.
Oh, absolutely.
To make sure the underlying framework isn't misinterpreted.
That's the linguistic standardization part, and it is non-negotiable in accounting. You have to fight against convenience, against colloquialism. Developers, translators, they have to stick to formal, recognized accounting terms, even if a generic word seems easier.
Can you give us an example where generic translation would just break the whole process?
A perfect example is the word for reconciliation. If you use the common literal Turkish translation uzlaşma, it means agreement or compromise.
Which sounds nice.
It suggests meeting halfway. But in accounting, reconciliation is not a compromise. It's the exact matching of two records, like a bank statement and your ledger. No compromise allowed.
So what's the mandatory term then?
The standardized term is mutabakat. That word carries the precise technical meaning of exact financial matching. If your software uses uzlaşma, a financial professional might not trust the function's integrity.
That makes perfect sense. Uzlaşma is shaking hands on a deal. Mutabakat is matching the spreadsheet exactly. What about a term like journal entry?
It has to be yevmiye kayda. If you use a generic translation like toplu kayıt, which means batch record, you create operational chaos.
Why?
The sources point out that toplu kayıt causes confusion because the word for an inventory batch, like a manufacturing lot, is parti. You cannot have your financial record term confusing users about their inventory stock. It's a classic case where technical terms have to be specific and unique.
And I'm guessing this extends to the documents themselves, especially tax labels.
Absolutely. This was a critical fix mentioned in the sources. In Turkey business, the generic word for tax, vergi, is just dangerously vague.
Could be anything.
Could be payroll tax, income tax, stamp tax, anything. On an invoice, you need absolute clarity.
So what's the mandate?
Replace the generic tax with the specific acronym KDV, which is Katma Değer Vergisi, on all transactional documents. Your tax invoice must be a KDV faturası, and if something is tax exempt, it has to be labeled KDV-siz. This ensures the paperwork lines up perfectly with what an auditor expects.
We've covered human error, regulatory divergence, and linguistic precision. But the sources also pointed out something interesting, that the software tools themselves created problems, specifically around a dynamic replacement feature, this unify button. What was that developer nightmare?
It's a classic case of aggressive automation just completely backfiring. The Unify button was designed to save time by converting references to the app's name like osFinancials into a dynamic placeholder at appname at SD.
To make rebranding easy, I assume.
Exactly. But it was way too zealous.
What did it do?
It replaced everything. First, it broke references to older legacy versions, like TurboCASH 2.03, which you need for data migration checks. The software suddenly couldn't identify its predecessor because the name was just a placeholder.
Okay, that's bad, but I assume the broken web links were the real headache.
They were catastrophic. The automation aggressively found static URLs in the help files, like https://www.osfinancials.org, and converted them into a dynamic placeholder. You'd end up with a totally broken link, like https://www.appname at SD
Oh, no.
Every single web link, every support link that was unified by that button then required someone to go in manually and revert the domain back to the static functioning URL.
So a localization shortcut turns into a QA disaster that needs tedious manual fixing.
Mm-hmm.
It's a perfect metaphor for this whole deep dive, really. Every simplification is undercut by some mandatory complexity.
It just shows that localization isn't only about language skills, it's about anticipating how automation interacts with unique regulatory and legacy constraints.
And they standardize everything, right?
Right down to the smallest detail. One final thing that just sums up the obsession with consistency, even number abbreviations. The team had to enforce that the term number, numara, must be abbreviated consistently as no, with a period, as in fatura no, on every single screen and document.
So what does this all mean?
It means that successful financial software localization in a multi-jurisdictional environment is just an exercise in extreme diligence. It demands mastery of both macro-fiscal law, like knowing the difference between a 9-class TDHP and a 10-class EU structure.
In the micro details.
And the critical micro details, like configuring the software for 5% and 16% TRNC VAT rates separately, and enforcing standardized terms like mutabakat to ensure legal clarity. It's really a testament to the amount of rigorous engineering that goes into making global commerce compliant.
And our final provocative thought for you to explore after this deep dive. This whole process reveals that in global commerce, technical compliance is often a race to zero tolerance. The margin for error is razor thin. The difference between a legal operation and a critical tax error can literally be reduced to a single digit, the correct sub-account number, like 191.05, tied to the correctly translated tax acronym, KDV, in a very specific regional context. Just think about the hidden effort required to make even the simplest invoice legally viable around the world.
That one digit carries the weight of years of legislative history.
Thanks for diving in with us today on The Deep Dive.